The institutional architecture and the internal management advantage. The foundational thesis for any evaluation of Hercules Capital must begin with its organizational structure, which serves as a primary driver of its long-term competitive advantage. Unlike the majority of its peers in the BDC sector, Hercules is an internally managed company. In the standard BDC model, an external investment advisor manages the portfolio in exchange for a management fee, typically ranging from 1.0% to 2.0% of gross assets, and an incentive fee based on net investment income and capital gains. This external model can create inherent conflicts of interest, often incentivizing the expansion of the asset base to maximize management fees, potentially at the expense of credit discipline. Hercules Capital's internal management structure eliminates these external layers, aligning the interests of the management team directly with those of the shareholders. The management team is employed directly by the BDC, and their compensation is tied to the long-term performance and credit health of the portfolio. This efficiency is a critical component of the bull case, as it allows a greater portion of the company's 12.5% core yield to be retained as net investment income, NII, and subsequently distributed to shareholders. Furthermore, the internal model provides greater transparency into the company's operating expenses and corporate governance, a factor that has contributed to its ability to maintain investment-grade ratings from major agencies, such as Moody's Baa2 and Morningstar DBRS BBB High.
The strategic importance of this structure was amplified by the 2018 Small Business Credit Availability Act, which permitted BDCs to increase their debt-to-equity leverage ratio from 1:1 to 2:1, provided they received board or shareholder approval. Hercules utilized this flexibility to scale its lending capacity without the immediate necessity of dilutive equity raises, a move that helped the platform surpass the $25 billion cumulative debt commitment milestone by October 2025. This scale provides a network effect in venture lending. As the largest non-bank lender in the space, Hercules is often the first call for venture capital firms seeking to complement equity rounds with non-dilutive growth capital. The bull case, operational momentum, and defensive rotation. The bullish perspective on Hercules Capital is rooted in its ability to generate record financial performance even during periods of macroeconomic uncertainty. The fiscal year 2025 represented a watershed moment for the company, characterized by record levels of commitments, fundings, and investment income. This momentum is viewed by proponents not as a cyclical peak, but as a demonstration of the platform's maturity and its ability to capture market share as traditional commercial banks retreat from the venture space due to regulatory mandates and restrictive capital requirements.
Record financial performance and distribution strength. In 2025, Hercules reported total new debt and equity commitments of $3.92 billion, a staggering 45.7% increase over the prior year. This volume of activity suggests that the demand for venture debt is decoupling from the volatility of the IPO market. As venture-backed companies stay private longer, the need for mid- to late-stage growth capital has intensified. Hercules has positioned itself to meet this demand, funding $2.28 billion in 2025, a 25.9% year-over-year increase. This operational success has translated directly into shareholder returns. The company's net investment income for Q4 2025 was $87 million, or 48 cents per share, which provided 120% coverage of its 40-cent base quarterly distribution. The ability to consistently over-earn the dividend has allowed Hercules to build a significant spillover of undistributed taxable income, which stood at $149.9 million, or approximately 82 cents per share at the end of 2025. This spillover acts as a powerful defensive buffer, ensuring dividend stability even if the company faces a temporary decline in origination activity or an increase in credit losses.
Furthermore, the board's confidence in the platform's earnings power was evidenced by the announcement of a new 28 cents per share supplemental distribution for 2026, to be paid in 4 equal quarterly installments. This marks the 6th consecutive year of supplemental distributions, a track record that few in the BDC space can match. For yield-seeking investors, the combination of a high base dividend and consistent supplementals creates a compelling total return profile, especially when the yield is backed by a portfolio of senior secured assets. The strategic shift to life sciences. A critical component of the 2026 bull case is the company's proactive rotation into the life sciences sector, which serves as a hedge against the current volatility in the software and SaaS markets.
In the fourth quarter of 2025, life sciences commitments accounted for approximately 69% of all new activity. This strategic pivot is supported by improving fundamentals in the life sciences ecosystem. While the IPO market for biotech was mixed in 2025, M&A activity accelerated sharply as large pharmaceutical companies sought to replenish their pipelines through acquisitions.
Venture capital funding in life sciences remained disciplined but productive in 2025, with a trend toward larger, concentrated rounds for de-risked, later-stage companies. Hercules focuses precisely on these types of venture growth companies, those that have already achieved significant clinical milestones or have established regulatory pathways. By lending to these entities, Hercules secures its position at the top of the capital structure of companies backed by billions in junior equity. The bull case highlights that the equity cushion in these deals is substantial. Even if a company's valuation is cut in half, the senior secured debt held by Hercules often remains fully collateralized by intellectual property and other assets. The Advisor LLC and the platform expansion. The evolution of Hercules Advisor LLC, the company's wholly owned RIA subsidiary, has added a high-margin, capital-light revenue stream that differentiates HTGC from traditional BDCs. The Advisor subsidiary manages external private credit funds, allowing the Hercules platform to participate in larger transactions than the BDC could support on its own. In 2025, the private credit fund business delivered $23.4 million in dividends and other contributions to the BDC, a 33% increase over 2024.
Management has signaled that this segment will continue to grow, with Fund 4 expected to reach a final close in 2026 and discussions already underway for subsequent vehicles. This platform approach creates a virtuous cycle. The BDC benefits from fee income and shared expenses, while the broader platform gains the scale necessary to compete for the most attractive deals in the venture ecosystem. Proponents of the stock argue that the market significantly undervalues this asset management business, which provides a level of earnings diversity and scalability rarely found in the specialty finance sector. Interest rate sensitivity and the floor protection. A common concern for BDCs in a declining interest rate environment is the potential for narrowing net interest margins. However, Hercules has built significant protection into its portfolio. As of year-end 2025, approximately 75% of the company's prime-based loans were at their contractual interest rate floors. This means that while the company's cost of debt, which is largely fixed rate or already hedged, may decrease or remain stable, the yield on its assets will not fall below a certain level, even if the Federal Reserve continues to cut rates. This asymmetric interest rate sensitivity is a major pillar of the bull case. It allows Hercules to maintain its 12.5% core yield in a shallow rate cut environment, preserving the NII necessary to cover its high distribution levels. Furthermore, the company has demonstrated an ability to raise capital at attractive rates, such as its $300 million institutional notes offering at 5.35% in early 2026, which further optimizes its cost of capital and enhances the spread for shareholders. The bear case, sector contagion and forensic scrutiny. The bear case for Hercules Capital is not centered on a lack of growth, but rather on the quality of that growth and the risks inherent in its portfolio concentration. The SaaS-pocalypse of early 2026, which saw a $300 billion evaporation of market value in the software sector in just 48 hours, has cast a long shadow over Hercules' $1.5 billion software loan portfolio.
The software contagion and valuation skepticism. Bearish analysts point to the company's 35% exposure to the software sector as a primary vulnerability. The narrative of budget exhaustion among corporate CIOs and the shift in capital toward AI infrastructure at the expense of traditional application software has led to a dramatic compression in SaaS valuations. Software price-to-sales ratios, which averaged 9x in 2024, compressed to 6x by mid-February 2026. The core of the bear case, most famously articulated in the Hunter Brook Media short report of February 2026, is that Hercules is marking its software debt at 100 cents on the dollar, despite the broader industry's distressed conditions. Critics argue that the company's reported 0.2% non-accrual rate is a lagging indicator that fails to reflect the reality that many of its borrowers are zombie companies, unable to innovate or refinance their debt in the current high-interest rate environment.
There are also significant concerns regarding the company's valuation process. The Hunterbrook report alleged that a small, overstretched team of just 4 people is responsible for valuing the entire portfolio, with few checks or cross-team reviews. These allegations of aggressive accounting have triggered a series of securities fraud class action lawsuits, adding legal and regulatory risk to the bearish thesis. The PIK income credit canary. Perhaps the most technical and alarming component of the bear case is the rapid growth of payment-in-kind (PIK) income. PIK allows a borrower to defer cash interest payments by adding the interest to the principal balance of the loan. While this is a standard feature in some venture debt contracts, its proliferation can be a signal of credit stress, where borrowers are unable to meet their cash obligations.
Hercules PI income more than doubled from $24.7 million in 2023 to $55.9 million in 2025, now representing 11% of total interest and dividend income. More concerningly, the actual cash collected on these PI receivables collapsed by 73% year over year, falling to just $4.9 million in 2025. Bearish analysts argue that this phantom income artificially inflates the company's NII and dividend coverage. If PI income is excluded, the cash-based coverage of the total distribution, base plus supplemental, falls below 100%, which could force a dividend cut if the company cannot realize sufficient capital gains from its equity and warrant portfolio. Refinancing risk and the 2026 maturity wall. The broader BDC and private credit markets are facing a maturity wall in 2026, with approximately $12.7 billion in unsecured debt set to mature, a 73% increase over 2025. For Hercules, the cost of refinancing its own debt could rise significantly as liquidity providers such as JP Morgan pull back from the private credit space. If the company is forced to refinance at higher rates while its asset yields are capped by contractual floors or competitive pressures, its net interest margin will contract.
Furthermore, the sauce-pocalypse has made the refinancing environment for Hercules portfolio companies treacherous. If venture capital firms are unwilling to provide follow-on equity rounds and the IPO window remains selective, Hercules may be forced to choose between restructuring loans, often involving more PIK, or taking companies through a costly foreclosure process. Bears argue that the company is playing catch-up in assessing its exposure to AI disruption, and that many of its legacy software companies are now fundamentally impaired. Market sentiment and technical headwinds. The market's reaction to these concerns has been severe. The stock price plunged roughly 8% on the day the Hunterbrook report was released, hitting a new 52-week low. Short interest in the stock surged to over 8 million shares, reflecting a growing conviction among some market participants that the HTGC premium valuation is no longer justified.
The bearish narrative is further supported by recent analyst downgrades. Piper Sandler reduced its rating from overweight to neutral and cut its price target from $20.50 to $17.50, citing the revenue shortfall in Q4 2025 and broader sector concerns. UBS also slashed its price target from $19.50 to $15, maintaining a neutral stance as it monitors the fallout from the software sector volatility. For bears, these moves signal the end of Hercules' era of unmitigated outperformance. Pure metrics. A nuanced understanding of Hercules Capital requires a comparison against its primary competitors in the venture debt and specialty finance space. The venture debt market is smaller and more specialized than the broader middle market lending space, meaning that firms like Triple Point Venture Growth, TPVG, and Horizon Technology Finance, HRZN, provide the most relevant benchmarks.
HTGC versus Triple Point Venture Growth, TPVG. Triple Point Venture Growth has served as a focal point for the bear case against venture debt as a whole. TPVG has suffered from significant credit deterioration and high non-accrual rates, which has led to a massive discount in its stock price. Proponents of Hercules argue that HTGC's internal management and superior scale have allowed it to avoid the pitfalls that have plagued TPVG. However, the bear case for Hercules suggests that HTGC is simply earlier in the cycle and that its larger size will make the eventual correction more painful. While Hercules reported a 0.2% non-accrual rate, TPVG struggles highlight how quickly a venture debt portfolio can sour if its borrowers cannot access equity markets. Credit grading trends. The internal credit grading of the Hercules portfolio provides a more granular look at its risk profile. The company uses a 1 to 5 scale, where Grade 1 represents the highest quality and Grade 5 represents impaired assets.
The slight shift from Grade 1 toward Grade 2 and 3 credits over the course of 2025 suggests a subtle cooling of the portfolio's overall health, though the absence of Grade 5 credits for 3 consecutive quarters remains a strong point for the bull case. The bear case, however, argues that these grades are subjective and that the company's valuation of its Grade 3 software companies at par is precisely what is being challenged by the market. Macroeconomic drivers and sector outlook for 2026. The performance of Hercules Capital in 2026 will be dictated by several mega forces that are currently reshaping the private credit and venture capital markets. The golden age of private credit versus the maturity wall. Many industry leaders, including those at BlackRock and Morgan Stanley, believe we are entering a golden age for private credit. High interest rates have provided attractive coupons for lenders, and the retreat of banks has created a massive addressable market, estimated at over $30 trillion globally. The growth of individual investor access to private credit via semi-liquid vehicles, like interval funds, has further fueled the asset class, which grew to $1.34 trillion in the U.S. by mid-2024. However, this golden age is colliding with the reality of a higher-for-longer rate environment that is beginning to strain the capital structures of leveraged borrowers. The $12.7 billion BDC maturity wall in 2026 represents a 73% increase over 2025, and the cost of refinancing this debt could consume the very yields that have attracted investors to the sector. For Hercules, its investment-grade rating is a critical asset, but it does not insulate the company from the broader liquidity pullback seen in tech lending. Venture capital liquidity and the IPO window. The exit environment for venture-backed companies is the ultimate driver of venture debt performance. In 2025, venture equity deals were subdued, and companies faced a higher bar for raising capital. While IPO momentum showed some signs of life in the third quarter of 2025, many down-round IPOs became necessary to provide liquidity to early investors. In 2026, the secondary market for venture stakes is expected to go mainstream, providing an alternative path for liquidity. For Hercules, a more active secondary market or a broader IPO window would be highly bullish, as it would facilitate unscheduled early repayments and allow the company to realize gains from its warrant portfolio. In Q4 2025, early loan repayments totaled $149.7 million, and management has guided for $150 million to $200 million in Q1 2026. If these prepayments accelerate, it would provide the cash flow necessary to offset the concerns regarding PIK income.
The AI disruption and software valuation reset. The impact of AI on the software sector is perhaps the most significant wildcard for 2026. While AI is driving massive demand for infrastructure, data centers, chips, it is also disrupting traditional subscription software models. AI-native challengers are emerging with leaner operating models, potentially rendering legacy SaaS applications obsolete. Deloitte predicts that by 2030, AI agent-powered solutions could represent 60% of the total addressable software market. For a lender like Hercules, the risk is that its legacy software borrowers may not have the capital or the agility to transition to this agentic future. If the moats of these companies are breached, the senior secured debt held by Hercules may be less protected than historical loss rates would suggest. This technology risk is at the heart of the bearish contention that venture debt is currently ununderwritable in the software sector.
Conclusion. The dual perspective analysis of Hercules Capital reveals a company at the center of a market debate. On one side, the bull case presents a picture of a best-in-class platform that is successfully navigating a complex environment by leveraging its internal management, its strategic RIA subsidiary, and its disciplined rotation into a resilient life sciences sector. The record financial performance of 2025 and the robust dividend coverage provide a quantitative foundation for this view. On the other side, the bear case presents a canary in the coal mine scenario, where aggressive valuation practices and a growing dependency on non-cash PIK income mask a fundamental deterioration in the company's core software portfolio. The allegations in the Hunterbrook report and the subsequent wave of litigation have created a crisis of confidence that has decoupled the stock's price from its reported NAV.
As we move through 2026, the resolution of this debate will likely hinge on three factors. 1. The persistence of credit quality. If Hercules can maintain its non-accrual rate below 1.0% through the first half of 2026, it will go a long way toward discrediting the short thesis. 2. Cash collection on PIK. A reversal of the 2025 trend, where cash collections on PIK loans begin to rise as companies exit or refinance, would alleviate concerns about phantom earnings. 3. The maturity wall execution. The company's ability to refinance its 2026 maturities at rates that do not significantly impair its net interest margin will be a key test of its investment-grade status.